Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel and to all the subscribers. I greatly appreciate it. Channel's grown a lot and I'm really enjoying reading all the comments and stock suggestions. I'm trying to get through the comments. Please bear with me, but I am seeing them and I greatly appreciate the feedback on my videos and how I'm doing as well as what to do next. I'm definitely hunting for the next stock within that list. Thank you very much. Today we're going to look at Target, obviously the monster retailer here in the US, and we're going to look at their financials, see what they're doing, and see whether we think they might go. But first, this channel is dedicated to the cash flow investor. That's why I call it rational investing. We're rationally looking at intangible value. Tangible value is based on cash flow. So we want to take a look at what the cash flow of the business is and where we think it's going to go. That will tell us what it's worth. We then compare it to the stock market price that we can buy it at. And if there's a difference, that difference is the economic return for the business that we will realize over the period of time. We evaluate all of our stocks with 5 key attributes. That would be top line revenue growth, Ebitda growth, which is the enterprise-wide earnings, a free cash flow growth, well-priced and low debt. Those 5 key attributes are what we look at for all investments. Please check out my Domino's versus Google IPO video. You can see what a well-priced stock, such as Domino's, at the time at IPO can actually outperform Google due to the multiple of earnings you paid for at the time of purchase. All right, let's dive into the annual report. Behind me is the 2019 Target annual report. Their fiscal year ends in January 2020. So it's called the 2019 report because it begins February of 2019, runs for 12 months ending January 2020, and the bulk of the years are lying in 2019, so it's the 2019 report. One thing I did like, first off, some kind of high-level summary stats, which you can read. It's kind of this normal stuff. You got a statement letter, which mainly talked about COVID and what they're trying to do about it. But I liked this section here, just 3 pages in, really high-level, but great 5-year history of what the company is, where it's going, its debt level, its operating margin, some of the key things that even I look for. It was right there, and I really appreciate that. I also appreciate the fact that when they talk about long-term debt, which is down at the bottom here, long-term debt, they include the current portion. And oftentimes when people say long-term debt, they are excluding the payment of the long-term debt that is due in the current year. And that's not right. When you look at total debt or any debt on the balance sheet, you need to look at the current debt, current liability section, find the current portion of long-term debt, and then look at the long-term debt and find the long-term portion, add the two together. So I like that they're already doing that for you here. I pulled this number. I also pulled the lease obligations, added those two up. That's my total debt. Let's go through and look at how they've been performing. So here, revenue-wise, 2011 to 2019, revenue was $70 billion, and it moved to $78 billion. It's roughly an $8 billion lift over the 8 years. It's a 1% annual movement. Which is lackluster to say the least. Recently, it looks like they had a little bit of growth, 70 to 80%. That's a 10% move in 4 years, which is good. So I think recently they're trending a little higher, but historically they have not done well on the growth. That 1% number is not even above inflation, so you're losing revenue in real dollars, which is a problem, especially if the US does experience inflation given how much money we're printing. So I think that's an issue. I mean, technically, it checks the box because we look at nominal growth. So it does check the box, but we're definitely, everything else needs to be shining for us to take that one on. Ebitda. So for those of you who are new to the channel, Ebitda is earnings before interest, tax, depreciation, and amortization. The way we look at the business is at the enterprise level. And when you look at the enterprise level, it is pretending the business has no debt on it. What is just the inherent value of the business before you lay on a capital structure? Much like if you look at buying a home that you're going to move into, the market price of the home doesn't include any debt on it. It is the market price. You then go to a bank and say, hey, can I borrow something because I don't have all the money to buy it? And the bank gives you money with which to go buy the business. The same thing here. The enterprise value is the value of the business. The debt level means how much do you really own because you put debt on the business. So we look at an unlevered, as it's called, business, and to do that, to measure earnings on an unlevered basis, we use Ebitda. Okay, so Ebitda has gone from 7.5 billion to 7.3 billion, an actual decline of 0.3%. So we'll call this zero growth on the Ebitda. For long term, even more recently, 7.3 billion to 7.3 billion, that's flat. Recently, they have increased their, I think this is actually after this was released, they increased their minimum pay. They raised the pay to $15 an hour. So I think what they're seeing is they're seeing cost pressures from employee bases rising as competition is keeping their top line revenue tamped down, especially if they're not able to open more stores and really find a new way to engage customers. I know they are opening new stores, but I meant like finding new channels with which to grow, such as online delivery and so forth. It seems like they have been kind of stuck in a little box. They need to figure out how to break out of that to really move this needle north. So technically, it does not check the box. It's not growing. So revenue's there, Ebitda is not. Let's look at debt level and how it's priced, and we'll come up with what we think the value is. So debt level, $17 billion to $13 billion, actually came down, which is nice to see. It's still $14 billion, not unreasonable given where they are on Ebitda. Cash, this is excess cash. This is cash that they don't need to operate the business. Typically, companies will park that in a line called marketable securities on their balance sheet. Nothing was there, so I'm not adding any cash back. As a reference, what does this mean inherently? This is essentially undistributed prior earnings that haven't been sent to shareholders and aren't needed on the balance sheet to help with the general workings of the business. And if you bought the company lock, stock, and barrel, if it was acquired by Walmart for some reason, let's say, the shareholders of Target would say, hey, you've got excess cash in your balance sheet from years prior that you generated that you never dividend to us. So before you sell to Walmart, dividend out all that excess cash so I get it, then go sell the business. That's what excess cash means. And when you buy a business as a private individual or even as a company, you buy businesses with no excess cash. Typically, it's called kind of a net working capital that they will trade with. And so here, what we're looking for is excess cash. There is none. So that's a little explanation on the excess cash. I've been seeing more comments on that. I wanted to give that another minute. Market cap has gone from 35 billion to 64 billion. Again, that's average share price for the month times shares outstanding. Enterprise value 52 billion to 78 billion. Not much of a growth there, but it is based on the market cap growth. Multiples interesting here. So this is the enterprise value divided by Ebitda. This is our pricing multiple that we use as a market multiple to gauge the the pricing of the stock. Is it expensive or is it cheap? And you could have paid in the past 7 times Ebitda. What does that mean? That means you take this number, which is the enterprise level earnings, times 7, and you get your enterprise value. Or said a different way, if you bought the company at this price within this fiscal year, you would have paid 7 years of earnings for that company. That means after that, the company would have essentially generated enough earnings to pay for itself, and you're kind of playing with the house's money after that. And that's a good thing. You want return of capital first before you get return on capital. That's what cash flow investing is. So paying a 7 times multiple is a good price actually for this company. It gets a little rich here, so it's moved up to 11 times, and now it's 12.5 times. And what you're seeing is this growth here. We looked at revenue, 70 billion to 78 billion. It is lifting and it's driving this multiple up. Also, with the stay at home, everyone is shopping and cooking more, so Target is getting more traffic, and I think the market's responding with an uptick in the pricing multiple they're willing to pay for the earnings because they think they're going to grow. So this is getting a little rich. I actually think it's fairly well valued for how big the company is. 7 times is cheap, is dirt cheap in my opinion. Last column on the end is debt to Ebitda. So that's taking total debt divided by the Ebitda. We look for no more than 3 times debt to Ebitda. That is a metric that senior banks look at. Big senior banks, Citi, JP Morgan, Wells Fargo, these guys that put on a lot of money and are very, very conservative with when they lend, they will typically lend 3 times Ebitda as a senior note. So that's kind of like your mortgage, and they will lend you 3 times your cash flow as debt. After that, you become kind of junior debt, and it becomes more expensive. There are other issues, and the risk of bankruptcy goes up. So us as equity investors, we want to buy companies with very little debt, because if they were to go under or need restructuring or have issues, we are the last ones in line at the courthouse. When you're trying to talk to the judge to get your money back after you sell all the assets, you've got all the banks, lenders, employees, vendors, everybody in front of you, the last person. So you have to make sure that there's as little debt as possible. That means there's fewer people in line if something happens to the business and you need to go ask for kind of a liquidation sale. So that's very important, and it does meet our criteria. It's less than 3. So let's review where we are. Our P&L revenue technically does, but 1% really doesn't meet it for us. Let's see what it was recently, just for fun. So if I look at kind of last couple periods, that's 4%. So that's not bad. You can't see that. So recently, it has been growing higher, and that's what people have responded to. It had a flat line and then suddenly 4% growth. So that's nice to see. We're going to use more of a metric like that going forward. Cash flow. Cash flow from operations, $5.4 billion to $7.1 billion. That's a 3% growth, which is stronger growth than we saw for the Ebitda. But both in line. It's not, one's not -10, the other's plus 12 or plus 20. This one's 3%, the other one's 0. That's close enough for the accounting smell check. CapEx, that's what they're putting back in their business to grow, to open stores, to renovate existing stores. All right, so you want to look at this and look at the difference, or compare the two. You compare $7 billion last year to $3 billion, which was reinvested. That means they kept $4 billion after operating and after reinvesting in their businesses. So then what? Then the debt payment. Well, they don't have much debt, so the debt payment isn't that bad, $330 million. That means the sum of these three gives me free cash flow to the equity holders. And this is what the enterprise value is based on. And that's $3.76 billion. That's how much cash they generated. That was no longer needed to pay debt. They don't need to reinvest it. It's truly distributable money. And I want to pause here for a minute, because a lot of people look at the dividend yield on a stock and judge that as cash flow, and whether or not they should, by buying a stock that has a 5% dividend yield, well, that's better than a stock that has a 4% dividend yield. In reality, that's not the case, because the dividend yield is a management decision to release amount of cash from this number, essentially. And what it does is it misses out on the cash that's retained or the cash that's used to buy back stock. And here you can see that they're buying back shares at a healthy clip, which is 3% annually. And that is where you are seeing the earnings. When you look at net income or EPS, earnings per share, every quarter or every year with Target, I almost said Starbucks, with Target, it is going up. But how is that happening? If earnings are flat, well, I guess recently it's kind of, earnings were flat, revenue grew, earnings were flat. How is EPS increasing? It's increasing because there's fewer shares outstanding divided by a flat numerator gives you an increasing EPS. So that there is kind of money that could have been dividend, it's not. But if you look at a dividend yield as a decision to buy, you are missing out on the true picture. And what you can do, if I take this and just go to the cash flow statement quickly, you can actually look at quickly to show you operating activities. Here we go. Net income, invest. Yeah, so this is the cash flow statement, and I'll show you exactly where you can look. So I hope you can see this. It's kind of thin. Operating activities, right? So this is the first third of the cash flow statement. It's always operating cash flow, and it usually has a dark line like this one. So here's your cash flow provided by operations, 7.117. That you saw in my other sheet right there, 7.1. That's CFO, cash flow from operations. CapEx is here, $3 billion. That's here, $3 billion. So that takes the first third and the middle third. The bottom third is the financing, and that's where you're going to find the dividend and the stock buyback. So here we've got additions to debt, reductions of debt. So these two numbers I'm netting on my cash flow to show where that cash is going. There it is, dividend paid. So if you just look at the dividend yield, then you're saying, well, they kicked out $1.33 billion. So I get a dividend yield, whatever it is, I'm going to judge the stock base. But you're missing this other $1.5 billion. It's actually greater than the money they gave for the dividend. They gave out $1.3 billion for dividend, but they paid back, they bought stock back in a total of $1.5 billion. So 1.3, 1.5. So if you judge the stock based on the dividend yield, you're missing the bigger picture. They're buying back stock twice at the rate of the dividend yield, more so. So really, you should take your dividend yield and double it for for Target, and that's a better picture of what the dividend yield is. So, side comment on the dividend yield, but it's an important one. So we've got this cash flow, $3.7 billion, and that actually lines up well with what they distributed. 1.3, 1.5, that's got 1.6. That's $2.9 billion that they kicked out of the $3.7 billion that they made. So they kept another $1 billion or $7 billion. 700 million, was retained. Shares outstanding gives me a free cash flow per share is $7.42. If I divide that by the average stock price at the end of the fiscal year, I get a yield of 5.8%. So that's what I'm doing here. I'm essentially, instead of taking just the dividend yield, I back out, zoom out, and look at all the cash flow and say, okay, all the cash flow divided by shares, that is the yield, the share price. That's the yield that I'm truly getting. Whether they retain it or kick it out as dividend, I get it in some shape or fashion. And what you'll see here is a strong yield. This company generates a lot of cash flow, and it's a high-yielding cash flow company, but it just doesn't grow. So it's kind of like a nice cash flow, steady dividend machine that's not really going to have a whole lot of top-line growth to it. So what do? Let's take a look at Ebitda. When I look at this, I'm giving it a 0 target to start with. The street's got a 3% growth. I'm not even sure how they get that. I think literally they just throw a number out there if they don't know what else to say. But historically, they have not been growing at 3%. Recently, revenue's been growing at 4%, but earnings have not. And with increased pays that the pay raises which they have given out, which are deserved, I'm not knocking, I'm just clinically speaking, that's not going to, that revenue raise might not flow through to stockholders. So if I keep it flat as an example, then that 7.3 billion of Ebitda is the same. I give it a 10 times multiple, which is a little lower than the 12 it's getting now because it's not growing. 17 billion of debt gives me a market cap of 55 billion, less the shares gives me $110 share price, which is below where it is now. So they definitely, the market's definitely pricing in growth. If I take this growth metric and I lay in 3%, there's the $150 price range. I think that's probably more what the street is pricing in. I'll leave that in here for going forward. If I take that and push it into the cash flow forecast, you get a nice $200 price target based at a $5 yield. Because the company does have strong cash flow, if they're able to grow a little bit, a lot of that free cash does fall through to the equity holders. So I think that's what you're seeing here. Let's take a look at what this looks like from a return perspective. You've got $150 share price, a $200 stock estimate based on a free cash flow, $150 based on an Ebitda market multiple, Split the difference, you got $173. If I put $173 into this IRR calculator, I'm buying the stock at 150. I get a stream of cash flows, which they can pay out as dividend or they can buy back shares with the cash. I'm indifferent right now. We're not putting taxes into this. We're just saying I'm indifferent. And I get out of it in 10 years, $173. That is an 8% IRR return, which is subpar for the market. I think this is going to be one of those below the mean S&P 500 returning stocks. 1.6 times your money, 1.7 times your money. If I put back the 0% growth, then the IRR falls to 4%. So I think that's giving you kind of a range-bound, long-term vision of the company. If they can't pivot dramatically to move earnings up above 3% annual growth rate, I don't think this company is really going to beat the S&P 500. So it really depends on what type of investor you are, what you're looking for. I'll put the 3% back. Just know that the delta between the two was, I think that was 4% and 8%. So that's a 4% IRR delta if they grow or don't grow. And I want to show you the distribution so you get a sense for, we're here, stock's $150. This forecast calls for an 8% IRR. As the stock swings day to day, year to year, month to month, this top price is going to fluctuate under which you can buy the stock. If the price should go to $200 a share, it's overvalued, and it's a 4% IRR holding it long term. If it comes back down to 10, kind of 110, 120, it's double digit and definitely a buy. So I think for us in this channel, we're going to give it a meh because it holds a number of boxes that we do look for. It does generate a lot of free cash flow, which is ultimately what we're buying. Even if revenue isn't growing and earnings are flat, the free cash flow is strong, the yield is strong, but it's not growing, and its IRR is below our hurdle rate. What this channel is looking for is really to beat the market long term, ideally. So investing in something that's got a good shot at being subpar the S&P 500, we're going to pass. But if you are a conservative investor needing cash flow, want to hold something long term as kind of an anchor to your portfolio, not a bad deal. It's just not for us. Okay. I hope you've liked it. This has been Target. Really appreciate the comments and thoughts. Keep the comments coming. Please subscribe. My name is Cameron Stewart, CFA. Thank you very much. Bye-bye.